Back in March, Barclays Capital was already proclaiming the arrival of green shoots. Recent economic numbers we've been seeing seem to support that call. And now, in its latest quarterly report, Barclays now says the green shoots have blossomed. And Barclays is repeating its recommendation for investors to maintain risk exposures. Joining us now is Barclays Capital's head of research, Larry Kantor. Mr. Kantor, welcome to Bloomberg News.
Thank you.
Let's talk about those green shoots for a minute. I was reading the Financial Times today. Samuel Britton had an op-ed piece. He called the debate about the green shoots absurd and that it misleads policymakers. I was wondering if I could get your reaction to that.
Well, I think from a policymaker point of view, one thing you don't want to do is take away the stimulus too soon. We saw the Bank of Japan do that early this decade. So they're going to keep their foot on the accelerator. Their job's different than my job. I'm paid to try to advise investors where things are going, and they're there to try to put in place policies that are necessary to ensure that they get there. And one of the reasons I am optimistic is because I think their policy is going to continue to be supportive.
Point taken. Has the U.S. bottomed compared to Europe and Japan?
Actually, interestingly enough, the U.S. is the laggard in this cycle, which is very unusual. Usually it's the U.S. that comes out first. In this cycle, Asia clearly came out of the gate first. We're seeing increases in industrial production in the second quarter in Asia that's, well over 50% at an annual rate. Now, they fell very sharply, but it really is a V-shaped recovery in Asia, and that's already been established. Those were the early signs we saw back in March. Europe, you're seeing some evidence that industrial production led by autos is probably picking up. I think the U.S., you're probably seeing production continuing decline into this month, into June. But we think that's the bottom. In other words, we think you will see it start to increase in July and August.
Let's stick with Asia for a second. Are they doing something right and we're doing something wrong? What are their numbers, their internals telling you?
I think to some extent, but not really. That's not the whole story. Certainly China put in place a lot of policy stimulus. They had the wherewithal, they had the will to do it, and they have the need. They need a lot of infrastructure spending and so forth. So China pumped a lot in there. I think the rest of Asia, to some extent, is also benefiting from the boost you're getting in China, which is quite large. But Asia was different in that they fell last and very hard because the U.S. and Europe, for example, have been slowing for a long time already. And when the shock hit to demand last fall and credit froze, a lot of the strength in Asia has been through exports. They lost their trade financing, so things just collapsed. Now we've had a restoration of credit flowing, demand's picked up around the world, and you're seeing Asia just bounce off very low levels. So I think it's more the nature of their cycle versus the cycle in the more mature economies like the U.S. and Europe.
And speaking of the U.S. and Europe, you do believe there's going to be a clear bounce towards the positive in the second half of this year.
That's right. I think what's happened with the market so far and why we've bounced so much is that investors have shifted from pricing in a significant probability of disaster to now thinking, well, we've averted the real meltdown disaster scenario.
But Mr. Kantor, a lot of people have said too it's a little bit too early to start popping the champagne corks, isn't it?
Well, I wouldn't be popping the champagne corks, and it's natural to be cautious after such a big rally that we've had. But what we're seeing here right now, I think investors are thinking that the U.S. will be stable at best, in the next 3 to 6 months. And same with Europe. And what we're seeing is a very big inventory cycle.
Right.
When you go down hard, you're going to pop. And I think people will be surprised at the strength of the numbers over the last few months.
Larry Kantor, the head of research at Barclays Capital. Mr. Kantor, if you would stay with us. He's been gracious enough to stay through the break. We'll have more with Larry Kantor. We're back with Barclays Capital's head of research, Larry Kantor, joining us. Mr. Kantor, thanks for staying with us. And I was wondering if I could get your comments on what Mr. Greenspan had to say today in the Financial Times.
Yeah, I largely agree with what he's saying. As far as the stock market's concerned, the way that works is prior to every recovery, you've seen a significant stock market rally, although there have been some stock market rallies that have not been followed by recovery. So it's sort of a necessary but not sufficient condition. So this rally is definitely something that makes you more confident that the recovery in the economy is going to happen. As far as this stuff about inflation, it's a good point, but it's not the issue now. In other words, and that's how Greenspan characterized it. It's an issue for the next, 5 years or something. That's all true. But in the short run, if you don't see economic recovery, inflation's just not going to be a concern. What it means is when you do see economic recovery, interest rates are going to be a lot more sensitive to that because we have piled on so much government debt. Once you get private demand for credit going again, that's going to put a lot of upward pressure on interest rates, and it's going to be important for the Fed to hike rates on time to prevent this from becoming inflationary. But that's not the issue over the next few months.
When you say hike rates on time, what do you mean?
Well, the Fed
in cadence with those cycles you were talking about?
That's right. In other words, once the U.S. recovery is established, okay, which it's not. In other words, right now, this is a forecast. And as I said, I think activities continue to decline into this month. It would be way premature for the Fed to start hiking rates now. But, if you're talking about next year, if we do have a recovery that's well established, they should not leave rates very close to zero. First of all, it would hit the dollar very hard, and then you risk really inflation once things go. So they'll have to start hiking rates as the recovery is well established.
And they'll have to keep a watchful eye on that jobless number, because as we saw on Wednesday, the rate stayed the same. It's at least from those who watch the Fed closely, they say they didn't expect the Fed to raise rates because you can't with a jobless number near 10%.
No, I think that's right. I mean, right now it's about 9.5. It's a little shy of 9.5. It's probably going to continue to edge up a little more. Most of that is done, I think. But that's going to be a difficult political thing because, with the unemployment rate high, it's going to be tough for the Fed to be hiking rates. But again, if they leave rates low for too long, we get an inflation problem, which means a much tougher time down the road. So that'll be tricky.
Mr. Kantor, you recommend sticking to risky assets, but are there certain assets that you would avoid?
Well, first of all, we've had a big rally. The issue really was that we faced when we put this thing together is, do you stay invested or not after this rally? We say yes for now. We think it's got more room to run, mostly because we think Europe and the U.S. in particular, growth is going to surprise on the high side in the second half. There's a lot of skeptics out there, we know that, and a lot of people missed this rally. Things really did look gloomy in March, and that's another reason to stay invested. We still have investors that need to kind of catch up with this, but we're on the alert. Once you do see that pop in growth, we're going to be very careful about advising investors. Maybe it's time to take some profit, but right now we're saying stay invested. Mr.
Kantor, we have about 30 seconds left. When this recession's over, are we going to see a return to the same fundamentals that got us into this problem?
No. What you notice is every time there's a bubble, this time we've had a housing and a credit bubble, the next bubble's not in those areas. So you're not going to see a credit-fueled, over-leveraged household sector. Where's the bubble going to come? It could be commodities, who knows, but it's not going to be there. So things will look different, and we see a very tame consumer going forward.
Larry Kantor, head of research at Barclays Capital, joining us this morning. Mr. Kantor, thanks for your time. Appreciate it.
My pleasure.